Navigating the uncharted waters. Considerations when investing in alternative assets. Introduction. In the ever-evolving landscape of investments, traditional avenues like stocks and bonds are no longer the sole domains for astute investors seeking diversification and enhanced returns. Enter alternative assets, enigmatic, complex, and often reserved for the more sophisticated investor. Among these alternatives, private equity and hedge funds stand out as formidable choices, offering unique opportunities and challenges. To embark on the journey of investing in these alternative assets requires a nuanced understanding of the considerations that shape this distinctive corner of the financial universe. The realm of private equity. Private equity represents a form of investment that involves funds invested in privately held companies or the acquisition of public companies, taking them private. The allure of private equity lies in its potential for substantial returns, often exceeding those available through traditional investment vehicles. However, this path is not without its intricacies, demanding careful consideration of various factors. One paramount consideration is the illiquid nature of private equity investments. Unlike publicly traded stocks, private equity investments entail a more extended investment horizon, often spanning several years. Investors must be prepared for a lock-up period, during which their capital is committed and inaccessible. This illiquidity, while posing a challenge, also aligns with the long-term, value-driven approach that characterizes many private equity strategies. Moreover, the due diligence process in private equity investments is exhaustive. Investors must scrutinize not only the financial health of the target company but also its operational efficiency, management team, and growth potential. Thorough due diligence is crucial to mitigating risks and ensuring that the investment aligns with the investor's overall portfolio objectives. Another consideration is the reliance on active management in private equity. Unlike passive strategies commonly associated with traditional investments, private equity often requires hands-on involvement. Investors should assess the expertise and track record of the fund manager, as their ability to add value to portfolio companies directly correlates with the success of the investment. The hedge fund conundrum. Hedge funds, another alternative asset class, have gained prominence for their potential to generate returns irrespective of market conditions. These funds employ a diverse array of strategies, including long, short equity, global macro, and event-driven approaches, providing investors with avenues to capitalize on market inefficiencies. However, delving into the realm of hedge funds demands a thorough examination of key considerations. One primary consideration is the fee structure associated with hedge funds. Unlike traditional mutual funds, hedge funds commonly charge both management fees and performance fees. While the performance fee aligns the interests of fund managers with those of investors, the total cost can be substantial. Investors should carefully assess the fee structure and evaluate whether the potential returns justify the expenses incurred. Leverage is another critical factor in the hedge fund universe. Many hedge funds utilize leverage to amplify returns, but this strategy also magnifies risk. Investors must be cognizant of the fund's leverage profile, as excessive borrowing can lead to heightened volatility and potential losses. Understanding the risk management practices employed by the hedge fund is essential to gauging the impact of leverage on the overall portfolio. Transparency is a key consideration when investing in hedge funds. Unlike traditional investments with daily liquidity and clear valuation mechanisms, hedge funds often operate with less transparency. Investors may face limited visibility into the fund's underlying holdings and the specific strategies employed. Conducting thorough due diligence on the fund's reporting practices and transparency measures is crucial to making informed investment decisions. The regulatory landscape. Both private equity and hedge funds operate in a regulatory environment that differs significantly from the more transparent and regulated world of publicly traded securities. Investors in these alternative assets must be attuned to the regulatory frameworks that govern these investments. Regulatory changes can impact fund structures, reporting requirements, and tax implications, influencing the overall attractiveness of these investments. Moreover, the accessibility of alternative assets is often restricted. Many private equity and hedge funds have high minimum investment thresholds, limiting access to a select group of accredited investors. Before delving into these alternative realms, investors must assess their eligibility and ensure compliance with regulatory requirements. Diversification and risk mitigation. While alternative assets offer the potential for enhanced returns, they also introduce a layer of complexity and risk. Diversification is a fundamental consideration in mitigating these risks. Investors must evaluate how alternative assets fit into their broader portfolio strategy and whether the risks associated with illiquidity, leverage, and market uncertainties are balanced by the potential for higher returns. Additionally, understanding the correlation between alternative assets and traditional investments is crucial. The allure of alternative assets lies in their potential to provide diversification benefits by exhibiting low correlation with traditional asset classes. However, correlations can shift over time, particularly during periods of market stress. Investors should assess how alternative assets may behave in different market conditions to gauge their effectiveness as diversification tools. Conclusion. Venturing into the realm of alternative assets, whether through private equity or hedge funds, requires a strategic mindset and a thorough understanding of the unique considerations that define this landscape. While the potential for enhanced returns exists, so too do complexities and risks that demand careful navigation. By embracing a holistic approach that includes due diligence, risk assessment, and alignment with overall portfolio objectives, investors can harness the power of alternative assets to diversify their portfolios and potentially enhance long-term performance. As the financial landscape continues to evolve, those willing to explore the uncharted waters of alternative investments stand poised to uncover new opportunities and navigate the complexities with informed confidence.